How's it going, August?
How you doing, Keaton?
Desperate need of a haircut. There were no good options.
I got one today, and there was no wait either, so it was great to see that.
Nice to meet you, Monica. I know
Hi,
we
nice
chatted.
to meet you. Yes. Great to meet you. I was happy to see you're on. I was like, wow, now I get to meet him.
How
are you doing, August?
Great, great. Thank you for being here, Monica, taking the time. We're just waiting for people to trickle in. It's just at 6 now, but go ahead. Go ahead if you guys want to chat it away and go on and do that until we get some more people coming in.
Excellent. So is everyone on camera at your thing, or is it just us? There's one more presenter, right? Troy? Is it Troy?
No, it was supposed to be Morty, but I haven't heard of him. We can bring on Troy to be a presenter if Morty doesn't show up soon. But let's see how it goes. So, all right. Usually these things take a few minutes for people to come on. But Morty is a mortgage broker in the US. That's why I wanted to have Morty on. So we kind of get Canadian mortgage and lending ideas from Keaton, and then we get that from, oh, there he is. Hey, Morty. We were just about to replace you with someone else, so you came just in time. All right. All right, so we still have people trickling in, and we will start shortly here. Morty, can you hear us?
I got you. How are you? How's everybody?
Great, great, great. So you have Monica and Keaton here presenting with us today. All right, so we have, let's see here. We have a fair amount of people. Oh, we got a couple more people coming in, so we'll start this any moment now. It's beautiful and sunny here in Vancouver. How's it there in Ontario, right, Monica?
Yeah, it's nice. It's a little bit cooler, but than it was before. We had a really hot week last week, which was great. But so the weather cooled a bit, but it's been really nice and sunny.
Awesome, great, great.
Yeah.
Good to see the warm weathers, because they say that the coronavirus doesn't survive in the hot weather, right? So we definitely want some warm and hot weather coming our way.
Yes, yes.
All right, I guess go ahead, finish up, Monica.
Oh, no, it's okay.
All right, yeah, so I get that we'll get the meeting going. It's being recorded as well, so people can listen to it later on. So I want to start off by kind of letting everybody know about myself and about the Multifamily Investor Nation meetup group that I host here in Vancouver. It's usually a meetup group in person, but obviously because of circumstances, it's taking place online. It takes place once a month on the first Monday of the month, and the discussion and the topics are mainly about investing in US multifamily. So we got a good group of attendees and individuals who come on board, and it's a great networking and educational meetup group that we have. Since we've had this meetup online, I thought it'd be great to bring a few professionals on to discuss the market. The meetup group is mainly about the US, but real estate investing is much more broad than that, and it's important to understand the Canadian real estate market alongside the US, because at times they kind of mimic each other. Vancouver real estate market is a bit different. It's a world of its own over here, but it's kind of good to get a perspective from both sides. So today we're going to have some great guests speaking. And just to let you guys know a bit more about myself. So August Biniaz. My background is in construction and development. I spent over a decade being involved in construction development of single family and multifamily, always looking for different investment opportunities for myself and my group of investors, and was focusing on construction and development. But now for the last year, my focus is on acquiring US multifamily rental apartment communities. And I do this through a process called syndication, where I partner with investors and other partners to raise capital and purchase these buildings, add value to these communities, and after a term to 3 to 5 years, we sell these assets. And the great thing is that with the cash flow these communities, these apartment buildings have, we're able to pay our investors pretty handsome yearly dividends distributed monthly or quarterly. So that's a bit about myself and about Multifamily Investor Nation, our meetup group. So let's kind of get right to it and introduce our guest speakers, and I'll give you guys, rather than giving you guys their background, I'll tell you about how I met them and my personal experience with them. I think that's an important perspective for you guys to have. I'll start with Monica 𝗖𝗽𝗶𝘁. Is that correct way of pronouncing last name? So
Yes, that's correct.
Perfect. So what I love about Monica is that the approach she has taken on doing her business is this educational approach, and that's I see that as very important and key. So she runs a group called Real Property Investments, and they have. So I would appreciate if you share your information, Monica, so people can follow that. So what they do, tell us a bit about. So let me just say. So when we met, and that's what kind of attracted me to Monica about the platform that she presents at this educational platform, educating, because usually you just hear when wanting to get involved in real estate investing, all you hear is these messages coming your way. Nobody's actually there taking the time to teach you the process, and even if they are, it's very much focused on what they do. And what I noticed with Monica and her team is that it is much more broad than that. They bring speakers all the time. There's so much great content that their group provides on multiple social media platforms and webinars. So really enjoyed that, and I'm looking forward to work with Monica for years to come. But please, Monica, go ahead, tell everyone a little bit about yourself, and after that, I'll ask you some questions about the market and the forecast.
Excellent. Well, thank you, first of all, very much, August, for having me in your group. And hi, Vancouver. I'm assuming most people are from Vancouver, and we have some American people there. So hi, nice to meet everyone. My name is Monica 𝗖𝗽𝗁. I'm a real estate investment specialist and wealth builder and owner of Real Property Investments. And I started off as a real estate investor over 10 years ago. My husband and I started investing in real estate because we knew we needed to figure out different ways to build wealth. And from that, we grew a group similar to what August has built here, which we call the Real Property Investments Networking Group. And we're based out in Toronto, Ontario. And this is before there was no networking group. So August, you're really great to put these things on, because these kinds of groups are an excellent resource for people. So over 10 years ago, there was no real estate group available except for RAIN. And I have 4 small children, so I didn't then, but we do now. I think we had 3 children then, and I think I was probably expecting number 4. And we weren't able to do that. So we started our own networking group, and from that, it kind of evolved into what it has become today, because I started off, like a lot of people here, as real estate investors wanting to learn to build wealth through real estate. I was looking for joint venture partners, and so the group really kind of transformed into an educational networking group as I evolved as a real estate investor. So my experience as an investor was, it's been a real journey, and we've been incredibly successful in our journey as we've achieved financial freedom through investing in real estate and alternative investment products, but it wasn't always that way. And I didn't have anyone to help me during my journey. So it gives me great service and pleasure to really tell people the real way to build wealth in real estate and alternative investments in real estate, so they don't have to go at it on their own. And so now we met you, August. We're excited because we are looking to kind of expand into the Vancouver area and different areas. And with the COVID-19 and the webinar platform, I think that's made it possible. So yeah, I'm excited to share our story.
No, that's great. No, that's wonderful. So kind of give us an idea that if someone gets involved with you, as far as, because real estate is a teamwork, you're going to need your mortgage broker, you're going to need your real estate agent, you're going to need somebody who's familiar with the area, possibly in the construction field. Is your guys, my understanding is your network is in a way that the assistance you provide investors is very broad. Kind of give us an idea about that.
Well, real estate investing education is $1 billion endeavor, and there's too many people charging too much information for too little support. So we've reversed engineered this process, and we will, for a little investment, give you a lot of support. And like you mentioned, part of the support is building out teams. So when you are looking, like 90% of the world's millionaires invest in real estate, and I think about maybe 6% of the entire population, at least in Canada, invest in real estate. And it's not because they know it's not a good investment. They know it's just they are confused. And a confused mind doesn't act. So everyone knows that investing in real estate is the #1 wealth builder, but they don't have that team and that support to move forward. They have unanswered questions, and they're often left to their own devices, piecemealing their team together. So the first thing we do at Real Property Investments, and for all our investment clubs, is we have fully sponsored teams of experts in place. And these are people that we have vetted, because I've worked with hundreds and hundreds of people, and we pride ourselves on picking and working with the best people in the industry. So that when an investor, finally has that feeling like we had, where enough, I want to move forward, but I don't know how, we can put them in touch with the real estate agent, like with Keaton, the mortgage specialist, like with the property manager, with the home inspector, with anyone that they need, to take all that guesswork out, so they have no more excuses, and the only thing really stopping them is yourself. Now, where we come in is, like I say, we've done every investment strategy under the sun, and that's not a good thing. Because we made a lot of mistakes learning, but fortunately it's made us an excellent consultant, because we can advise on all these different areas of investing, and invest the real way. So we don't do this OPM, low money, no money down, smokes and mirrors. You don't need money to invest. You do. And we are here to give that sort of real message. And once you really assess someone's situation and tell them the truth about how they really can move forward and fit them with a strategy that would work with them, whether it's actual buy, rent, hold real estate, or whether it's apartment syndication with yourself, they don't have any more excuses. And that's really what we help people do, is be transactional, because we will rip all the excuses away, and we also tell people the real truth.
No, that's great. That's wonderful. And just to mention a couple of items that about the points that you made is, there's a fear. I mean, the numbers of Canadians who don't invest in real estate. I mean, people kind of have this misconception about investing in real estate. If you just buy your primary residence, that's not really investing in real estate. It's when you go above and beyond that. And I think the fear here is that idea of being an active investor or passive investor. And as far as a passive investor, there are just so many options and so many unknowns. So when they get involved with someone with you, if that's a route they want to go as a passive investor, you kind of can have a look at different vehicles that exist and double check them for them, kind of give them the advice they need. And on the active side, you have all the professionals that they need, and they basically have guidance as they move forward. So I think it's a wonderful concept and idea, and I love to be part of it. So yeah, I appreciate a bit about background, and I really hope that I want you to share your information so everyone can get in touch with you and join your group. moving forward. Also, so now let's get about, so obviously you're in discussion with a lot of different professionals. Kind of give us an idea. I don't want the kind of our webinar to be about COVID, because there's just so much COVID discussions and talks, but it's something that we can't really get away from. So, and now it's been enough time since COVID. So kind of give me an idea about the current market. What are you seeing in the local Ontario, Toronto market, and also Canada-wide? Kind of give me your feel about currently what's happening, for everyone.
Well, I know exactly what's happening because my assistant gives me notes every week about everything that's happened all over the world. And I put on the Real Property Report, and we have a specialist come on, and because it's important to know what's happening, and it's important to give people, like I said, real information. And so what's happening, and we just had, thank you, you came on one of our events last week, and we actually had a global event. So we had people all around the world on, which is really exciting. So now I can actually chime in there. Generally in Ontario, we specialize in 6 high growth areas. And every area, we have teams of specialists in each one of these areas. And every single one of these areas are not, they're thriving. So multiple offer situations. I just missed out on a property. Actually, I found out during your webinar when you were on that I missed out on a property in Windsor, Ontario, actually. So everyone is still actively, there's not much available. And people are still bidding and putting in unconditional offers all across Ontario. And this kind of seems to be everywhere across, even in Canada, even in Calgary. I know they've obviously had a bigger hit because of the oil prices, and they're always a bit more tumultuous. But we're kind of like waiting for the prices to start to drop. And as of now, they're really not, just because we simply do not have enough inventory. So what everyone can guess till the cows come home, like our Barrie specialist is saying, don't do anything because the prices are going to drop 20%, or, or now there's nothing available. There's going to be a surplus in the market. Wait then. And then other people are saying, don't go ahead now and invest now. So when we invest in real estate, and when we work with our people to invest, a deal is a deal. So even 3 years ago, we had a huge drop in our market, and none of our investors ever lost any money because of that. Because if you go in with an eyes wide open approach, and you have the tools and the ability to recession-proof your investment, whenever you are investing in anything, you always want to ask yourself, what does this look like in a recession? And if you play around with your numbers, including mortgage rates, including drops in appreciation, including all these different aspects, you can invest in real estate. It is the number one investment that you can control. Now, for more of the private market and the passive stuff, a lot of the industries are thriving, and I think you, August, are going to do really well with your US apartment syndication. I know other people, private market products in the US, who actually are ready to spend $24 million on US commercial real estate, because the property is going to drop. The US, I think, will be hit harder than we are here in Canada, and there'll be more opportunities there. And when people are kind of investing in those things, and in the passive space, I think there's going to be a lot of different opportunities when you're investing in funds. So industrial warehouse, I think, is going to do really well. Commercial real estate may take a hit, but this is why it's important when people are growing their money passively, you're able to vet the issuer of these investments and really kind of put it through your sniff test and your recession-proof test.
Yes.
So
yes.
For the short answer is everything right now, nothing's happened yet. But if you look back historically in regards to past recessions, real estate is a huge lag. So it could be anywhere for up to 2 years.
Very true.
So anyone now should be just get ready to invest, but invest wisely, invest with a contingency, invest with drops.
Great.
And just ask yourself, what will this investment look like in a recession? Because we're probably going into one. I don't know.
If we're not in one already.
We could be. People say it's like the Great Depression.
Yeah. And in those sub areas that you're in within the Ontario, Toronto area, which one, if you were going to make a guess of which one you think would perform better than other ones, or which one historically has performed better, which one would you say is an area that you feel bullish about, that it's going to perform, in your opinion, better as far as job growth, population growth, kind of, what would be your number one pick for a region for it to invest?
Well, that's a great question. We've been in all of our markets for like almost 10 years. And so when we are in these markets, we've had to create what we call real estate investment models. So we used to buy single family homes in these markets. And when they used to be able to cash flow, and when they couldn't, we had to recreate our model and then create a legal duplex model. And the price goes up again. And now we've had to build, you know, like triplex, fiveplex conversions. So all the markets are pretty slow and steady because we don't invest for cash flow. We invest more so, you know, for appreciation. Obviously, that's to have some positive cash flow. But because we're in these high growth areas with strong economic fundamentals, we're not going to go to like tuk because it's just a high cash flow place. Those tend to go on paper. So everything is very similar in its thing, but we also identify areas with different like price points. And that's how investors who have less funds than others can participate in investing in real estate. So I think Windsor would have been my absolute favorite market because it's a lower price point, but it has very, very strong economic fundamentals. I know it used to be a disaster, but the city did a total 180. And the only problem with Windsor now is everyone is moved in to Windsor. So, you know, the prices are up. I'm talking like 50, like properties that were listed for 150,000 are selling for 330,000, and the numbers don't work. So you'll get like 55 registered offers on these properties, and it's crazy. So I would have said Windsor, you know, but now when everyone else is in that market, you have to make a choice as an investor. You either move to a different market, don't compromise with the fundamentals, or you can pretty much change out your investment model. But what's really on my radar right now would be industrial warehouse, for sure. Industrial warehouse space, I think, is going to skyrocket. It's going to boom. Even more so than it already is, because a lot of commercials are going to shut down, and a lot of people are switching to the online shopping, and a lot of the storefronts realize now they don't need to exist.
Yes, and if someone wants to invest in a warehouse in Ontario, you allow you have such a kind of a vehicle and plan to kind of work their way into investing in such a product.
I do. Well, we have experience in that, but mostly we would probably say take the passive route. So I have been a very active investor. Like for you, for example, God bless you for having apartment buildings because they're tough. I own a lot of apartment buildings, and you know, it's awful. It's tough work. And I think that passive investing, as you become more of a mature investor, and people have to realize, as a wealth builder, you don't have to own active real estate to be a real estate investor. I mean, you can still build wealth by diversifying with passive and active investments, and you can diversify your investments, especially with different types of real estate products, like passive products. So I think it's incredible that you have this apartment syndication where people don't have to manage tenants, you know, and toilets and do all that work. You have that real estate model built out, and it's a system that you do as a living as your real estate business. And people can benefit just as much by actually participating in those types of options or passive options than having to do it all themselves. And I think the more mature you come as an investor, the less you really want to have that hammer on your hand, and the more you want to have a golf club or a tennis racket in your hand. And you can still grow your money in some pretty amazing ways without having to do that all yourself. So if someone really wanted to come and say, Monica, teach me how to invest in industrial warehouse space, I mean, I could, but you know, when you have experts like yourself or other funds that we do raise capital for and personally invest in, quite often I just grow my money with other people. I'm done being the DIYer. I've had a lot more success in my life, and because time, money, freedom is really, really important, working with other people and just writing a check, not having to do it all myself, than I have working the 20-hour days and doing all the grunt work myself. So
I know, great points. And also, as a passive investor, they get to benefit from the economy of scale, pooling their capital together to be able to buy a bigger project. So yeah, no, great points. I really appreciate that, Monica. Please, I hope you stay with us, and I'll bring on our next speaker, Keaton. Hi, Keaton.
How's it going, August?
Good. I'll tell you guys a bit about Keaton. So I met Keaton at a real estate event, and the speaker who was supposed to, there was a bunch of speakers, but the speaker who was supposed to speak about the lending world, he wasn't at that event, and Keaton had taken his place. And in my opinion, he did the best speech and best interview. So it attracted to me, and I remember I went up to him after the meeting, and we exchanged contact, and we've kept in touch. And so very, very bright, sophisticated fellow. So he comes well recommended by me to everyone. So if you have any questions about mortgages or kind of that lending world, he's your man. And please keep tell everyone a bit about yourself, and we can also do the same thing, kind of idea about what you see with the current market. And I'll ask you some questions about your forecast, where do you think things are going as far as lending and what have you. But please go ahead.
Sure, sounds good. So I'm an investment-focused mortgage broker. I work with clients on the residential side and the commercial side. I've been in the industry 6 years, and my partner and I started out on another team under a broker. And we worked our way up to being 18th in Canada for all mortgage brokers. And then my partner and I left. I've spoken at 𝗖𝗣𝗜 events, RAIN events at the RAIN Acre in November. Work with a bunch of investment groups across Western Canada. And I own 2 JV properties in Edmonton myself, 2 fourplexes on 1 title. Just like Monica said, I'm a believer of don't do everything yourself. I pay professionals to do what they're really, really good at, but oversee the main properties. And we operate differently than most brokers. So most brokers only have access to TD and Scotiabank amongst the big 5 banks in Canada. And I guess 6 now. I think National Bank's moved up. But we have access to a network of relationships with BMO, HSBC, RBC, CIBC, National Bank. And we are focused on finding the solution for files as opposed to us getting paid. Our priority is to find the right solution for our clients. And our attitude is if we bring in enough business, it doesn't matter if we don't get paid on 30 or 40% of it. Our job is to help people. And if we help people, we'll succeed. And it works very well for us. And our model actually started working for top 1% realtors who would just send a lot of business. And it was a way for us to be able to give a value add back for them, making another 20 or 30% of deals happen and keeping clients out of B lenders by knowing the solutions outside of the mortgage broker channel. And it's slowly just evolved, and we're very, very client driven. And, ultimately the goal is to find a solution.
Great. Awesome. Yeah. So kind of give us an idea about what you see currently happening as far as the lending world is concerned, as far as the banks. Are you seeing the thresholds and the qualifications needed to get mortgages kind of have changed in this time? How do you feel about what's happening, and kind of give us an idea about the lending situation?
We've seen increasing pressure restrictions on 2 different sides of the lending spectrum. One is for real estate investors. Lenders have started clawing back loan to values. Getting 80% loan to value on an investment property is still possible, but it's getting increasingly difficult and requiring more and more of a relationship with the specific lender you're going to. Borrowed down payment on rentals is now more difficult. And overall, lenders are just taking a deeper look at how you're going to afford the property and how reliant on the rental income are you. So the investment side is getting a little bit trickier, but it's business as usual, just with a couple more speed bumps. But it's really requiring kind of a broader set of lenders to get things done. Being able to send everything to 1 or 2 banks just isn't happening anymore. And then on the other side, we're seeing the first-time home buyers and people purchasing properties to live in being affected. the insurer, I believe the stat that Monica was referring to from one of her realtor partners about the 9 to 18% is from CMHC, and it came out last week, and they're afraid that the market might drop 9 to 18%. And whether it will or won't, I think we could do a whole webinar on that, of how they derive that number even, right? Statistics can be skewed a fair bit, and if you include commercial real estate or you don't, do you do a median or a mean average of the property values? There's lots of things they can do to get numbers they want to really push a point. But what we are seeing is that if you're putting 5% down, it's less of a slam dunk by just fitting the requirements. There's a lot more scrutiny on how are you going to do over the next 12 months. We're personally big believers that, if there is going to be blood in the streets, as some people are expecting, it's not going to be now. It's going to be 6 months from when everyone started deferring their payments and their life insurance, their car insurance, their credit cards. So that's going to be kind of late August, September, maybe early October is where I think we're really going to see how things pan out, because no one's really going to panic sell and, flood the market with listings. People have no payments to make right now. So it'll be, and a lot of people are getting free money from the government, right? So
Yes.
Less stress right now. I think we'll see what happens in the fall is really going to be what drives the real estate side.
No, for sure. Great points. Great points. And how about as far as volume? Have you, obviously there must have been slowdown when the COVID first came out, but how about now? Do you, as far as the volume compared to pre-COVID, is kind of give us an idea about that?
Well, when things first started, it fell right off, and we were kind of happy with that while we saw what was going to happen in people's jobs and lender policies. But things are, I don't want to say crazy right now, but it's busy. I work with realtor teams across Western Canada and some in Ontario, and we're seeing multiples in almost every city. Like Edmonton, there are multiple offers on properties. And I haven't seen that in 4 years. So I think lower interest rates they're a palpable thing for buyers. It's, when interest rates go down, it's a real thing. It affects your payment. It's real. What the housing market may or may not do is an unknown for people, but I don't think it's as big in the decision making, because I think anyone who is long-term thinking realizes that speculating is not going to help you. If it goes up, great. If it goes down, who cares, as long as you plan on keeping the property for a prolonged period of time and you're getting the right advice to make sure that you're, in a strong financial position, you've dealt with debts that need to be dealt with, and, home ownership is a bit of a privilege for people. And I think they're starting to realize that and take advantage of low interest rates, but making sure their affairs are in order first.
Oh, for sure. Great points again. And as far, usually when you have a low interest rate situation happening, there's times also where the banks start competing with each other. Is that something that you've noticed yet? I think in the US, and we'll talk to Morty about this, I think there's some competition between banks, but it kind of give us an idea about that.
It's less so now. We're definitely, and I find that clients that are a little more sophisticated are realizing that a low interest rate's a low interest rate. I can't speak for everyone, and I don't have a bunch of letters after my name for my degrees, but I personally think there may be a lot of inflation with all the borrowing going on and what's going on in the economy. So when you're borrowing money at 2.5%, if you borrow it at 2.34 or 2.64, it's not going to make a substantial difference over the long-term ownership of the property and what your return is going to be. The reality is you're borrowing money for less than inflation, and it's a great time to buy. So I find that clients are shifting more towards the lenders that have the solutions than necessarily the lowest rate. So if it's about lowest rate, you're going to go to HSBC unless you're in the military, then you go to BMO, and you can go online and find low rates that no one can compete with. So it's less competitive on the lender side than we would normally see, because I think they're really managing their risk. And each lender, I think, just like if we all discussed, we probably have different views on what's going to happen. The banks are quite divided on it as well. Some are aggressive, some are conservative, and a lot are kind of sitting in the middle.
Great. And you mentioned earlier that you're focused on the investment side of mortgages. Is that something that kind of gives an idea about how, like, if somebody wants to get involved in investing, at what point do they get in contact with you? And is that more focused on cash flow property? So kind of give us an idea of that.
So I work with clients doing agreement for sale deals, rent to owns, vendor take back, commercial flips, also the full spectrum. So what a client's doing isn't really relevant to us. Obviously there's certain things that we can't help with. An example is US financing. So that's where Morty's going to really come in, and as a Canadian broker, you need to be licensed in each individual state. So it's very, very difficult for us in the Canadian side to be able to help, because, you know, I can maybe, if I got licensed in Washington, jump through a bunch of hoops, I could help clients there, but I couldn't help in New York or Las Vegas or wherever. So it's, you know, the US side, something we don't help with, but our primary focus is helping clients with the planning side. So, you know, the ideal time to chat with us is before you buy a property. Because one of the worst parts of my job is having conversation with clients about how we need to restructure their portfolios to, one, get them out of bad situations or negative cash flow, and also to help them continue to grow. And there is definitely an order of operations of growing a real estate portfolio. And if you don't follow them, you know, common best practices, if you want to call it, you can put yourself in a very expensive situation, especially in provinces like Ontario and BC with property transfer tax, where restructuring deals can be quite expensive. A common example would be buying an investment property with a partner where you're both two different households. You buy 2 or 3 properties together. One partner then decides they don't want to acquire any more real estate, but the other wants to move forward. What people don't realize is the lender is going to severely penalize you. And they're going to, if they use half the rent, then they're going to use 25% for you, because they will say you're entitled to all of the debt, but half of the rent due to the partner. Then the lender is going to take whatever percentage they use. So there's a lot of situations where we see clients where they're just getting bad advice. Another simple one is a bare trust agreement that for a long time REIN was heavily advising, which is great from a tax perspective in the short term. But what happens is that after a year or two, you end up in a situation where you have all of the debt in your name, all of the income in a corporation. So it's great for tax, but it's terrible once you get your T1s and the lender looks at them and says, you don't pay any of the rent to yourself. It's all in trust for a company. So ultimately, if you're going to acquire or grow an investment portfolio, or even you're just thinking of getting your first property, you know, it's a good time to chat with us. And we are also one of the only brokers in Canada. We're of a small group that are certified for the Smith maneuver. So I know Rob Smith, the author of the Smith maneuver, quite well. And we work with a lot of Canadians on the cash damming and Smith maneuver strategy to convert the debt on their residence from being non-tax deductible to tax deductible. And that can help you pay off your mortgage in like a third of the time and create significant tax savings. So there's quite a few different ways that we try to help our clients.
That's great. And definitely please share your, I think everyone got your guys' contacts and information in the email that I had sent out, but share it anyhow in the chat box here. And yeah, so I think we touched on many subjects there. Kind of give us your vision as far as what you feel the forecast is going to be for the market. So you know, what would your personal advice be to someone who you know, is looking to you know, get involved in real estate or purchase a property, you know, also on the investment side? So kind of break it down, that if somebody's looking to invest or somebody's looking for their first home, timing wise, or you know, and forecast, do you think, where do you believe personally the market is going in kind of a short term and long term here?
I'm personally a believer of long-term real estate. So if people want to flip, I definitely think you need to be more careful. Any short-term strategies in under 2 to 3 years, like agreement for sale deals, rent to owns, I think it's a time of caution. If you're buying long-term real estate, it's a great time. You know, I wouldn't be buying a property in multiples right now personally, but if you're in a position where you're one of the only interested buyers and you've got a seller who's motivated, I think it's a great time. You know, if it's long-term, who really cares what happens in the next year or two? It's about what happens long-term. And, you know, it's people obsessing about what the market will do is sometimes a major detriment to their investing in the long term. But, you know, I think if you're doing shorter term strategies or you really are trying to find a deal, I think the fall is when we're going to see what's going to happen. And there may be a glut of motivated sellers as people have to start making their mortgage payments again, and maybe they don't have jobs. Or they're not collecting money from the government anymore, and they're going to realize that, okay, this solution or this situation I'm in it's temporary. I can't defer mortgage payments forever. I can't hide from my credit cards. And I personally think the agreement for sale strategies are going to be very, very powerful, because there may be people with a lot of consumer debt that's unsecured that they need to deal with. And if they sell their home, but they're left with $100,000 or $50,000 in credit card debt, it may not be beneficial to sell your home and do that. There may be other ways to structure a deal, like through an agreement for sale, where you can, you know, pay off the debt, keep the property, but remove yourself from the responsibility of the payments. And, you know, these are kind of higher level things that you really want to put some planning in. But I think from an investment perspective, if I was a sophisticated investor, I would be looking at the agreement for sale side as the the potential home run strategy for the next year or two. But there is no magic answer, August. You know that. Monica knows it. I'm sure Morty does. It's, do what works for you, do what you can stick to and be consistent about, and what's going to let you sleep at night. I personally buy long-term properties, 10 to 15-year holds in a corporation, so they're tax efficient, 4 doors and 1 title. So I can get, 20 to 24 doors simply on the residential side with very cheap money. And I know that fundamentally it's going to double roughly in value over 30 years. All of the debt will get paid off. My rents should match inflation. And it's a retirement. I don't need to build up a $40 million portfolio, or to at least build a stable foundation of retirement, so that I'm in a position where I'm financially independent. Then I can start worrying about the big numbers. Whereas I think a lot of people want to get rich tomorrow. And that's one of the biggest setbacks that investors run into, is this trying to make their millions tomorrow. Real estate is a get rich very slowly strategy for most people. There are some like yourself, August, that are able to do crazy return on investment in short periods of time. But you're someone that's dedicated to real estate 24/7, and you're constantly talking to the experts. You're constantly exposed to it. So if you're not going to do that, and you're going to invest in real estate 3 or 4 hours a week, I'm personally a believer of just go for a long-term strategy. Let your tenant pay off your debt. Play the long game.
Good point. Thank you so much, Keaton, and I hope you stay with us, and I'll bring on Morty. So Morty 𝗖𝗽 𝗖𝗽. Morty is a mortgage broker from the US. I think most of our attendees are from Canada, so Morty will kind of give us a US perspective on what's happening with lending and banks, and also the kind of the market. To give you guys a little background about Morty, we got in contact not too long ago, but a while back, and pre-COVID, and we were in talks. And as soon as COVID hit, now this is nothing negative about all my other business associates, but over the years I have, my Rolodex of business associates is so broad and wide. But Morty was one of those people who kept in touch with me, saying, "Hey, how are you doing? What's happening?" and called and checked in, and that's something that stick to my mind. So I really appreciated that, and he's very knowledgeable. So I wanted to have him on our show tonight. So please, Morty, tell everyone a little bit about yourself, and again, I'll kind of ask you about the market, and kind of see what's happening with the lending situation in the US, and your future forecast. So please go ahead.
Yeah, no, so it was really interesting hearing the Canadian side from Keaton, and through our conversations, in the past couple months. But just to give you the US lay of the land, I'm with Meridian Capital, the #1 debt intermediary, multifamily intermediary year over year in the US. 2019 alone closed over $40 billion. The majority of that being multifamily. Close to 4,000 deals closed. So, we're all over the market, all over the country, just doing a tremendous amount of business. And that gives us, the knowledge to see what's out there, and, talking to all the players in the market. And, my belief in this game is stay in contact with the right people, and, the right things will come to you and to everybody else that you're staying in contact with. My personal way of doing business, my group, my team, is really to get in touch with people while they're young, while they're growing in this business. And we've helped many, many, many investors grow their portfolio from a couple hundred units to thousands of units. And that's really our business model, is to be a part of the business plan, and really just be there every step of the way, whether it's on the underwriting, or obviously then when it gets to the mortgage end of things, but really just be more of a business partner when it comes to that. And I think, that's what a lot of the people that we work with really appreciate, that, and really just being out there on the streets and understanding what's going on and keeping everybody informed. So, that's really my background and where we come from.
Perfect, perfect. No, I appreciate that. Before getting into kind of the market and what you're seeing happening right now, kind of give us an idea. I mean, here in Canada, we're familiar with our A lenders, B lenders, C lenders, kind of the main banks who we go to. And the US version of that is Freddie Mac and Fannie Mae. So kind of give us an understanding, what is Freddie Mac and Fannie Mae, and why are they the version of A lender, the main banks with you guys?
Yeah, so Freddie Mac, Fannie Mae, they are two federally backed firms that are focused on multifamily. That's all they do, is they put out billions of dollars of multifamily debt, and that's what their main focus is. They are the primary multifamily lender nationwide. And then on bottom of that, you have your balance sheet lenders. You have your bridge lenders, which would be for, a turnaround project, something that's not stabilized at the current, that you'd have to put the money in, and you want a little bit higher leverage. You're going to pay a little bit of a premium, but you have that, and then you have your balance sheet lenders as well, and then you have another program, which is HUD, which may not be ideal for syndicators, and we can get into that a little bit more, but it definitely has its ups and downs. But those are primarily your largest lenders: Freddie Mac, Fannie Mae, balance sheet lenders, and bridge, somewhere sprinkled in between for the right kind of deals.
Got it. And as far as rates, kind of give us an idea, what are the rates for the Freddie Mac and Fannie Mae currently for the projects?
Yeah, so Keaton blew me out of the water a little bit before by talking about 2.5% rates. We're not quite seeing that, but what's considered a really, really strong rate right now is low to mid 3% rates, which is what we're seeing on the Freddie Mac, Fannie Mae side of things. Which historically is a very, very strong rate. Over the last few years, it's been anywhere between, I would say, 4 to 5% traditionally. So, definitely opportunity on that end of things. They are putting in what they call a debt service reserve onto every loan, which is they're putting in 12 months of the principal and interest, where they're taking that as a buffer because of COVID. And that's something that's definitely front and center in investors' minds for obvious reasons. If you're a syndicator, that means you have to raise more capital, and it just hurts your overall numbers. But having said that, they're still being aggressive, up to 80% financing on acquisitions, up to 75% on cash out refinances. So, they're definitely still hungry and want to do deals, but it will be with that caveat of the interest reserve. It's going to be 12 months on most loans. On some loans that are a little bit lower leverage, a little bit more of a debt service coverage ratio, they'll knock it down to 6 months. But there's going to be somewhere, there will be some type of debt service reserve structure in all these loans.
Got it. And I think just maybe we'll get Keaton to jump in here, but I think Keaton was talking about residential mortgages, whereas commercial mortgages are a different animal here. So rates on commercial mortgages are totally different. So I think that might be the difference as far as the numbers. But Keaton, go ahead and jump in here and see if I'm correct or not.
Partially. So there's two types of commercial loans in Canada. There's insured, which are residential buildings that are insured by CMHC, and those are even lower. So on the CMHC insured side, you can see rates in the mid 1.5s, 1.9. They can be extremely low, but that's a very specific type of product. Typically, regular commercial stuff is going to be somewhere in the mid 3s, low 4s, depending on the deal, the size of the business, and the relationship with the lender.
Yeah, no, exactly, for sure. Thank you for that. And also, is it the type of deal? So if it's construction development deal, their risk is higher, so the rates will be higher. But as far as cash flow, kind of the deals that we look at, and Morty helps us with, our cash flowing apartment communities with high cap rates. So after the mortgage payments are paid, there's still a big surplus left alone. But Thank you, Keaton, for. But Morty, yeah, please jump back here. So, kind of give us an idea of what have you seen in the market. So you said that Fannie Mae and Freddie Mac, the main lenders, are still aggressive. The rates are lower than usual. How about other than the 1 year interest reserve? Have the qualifications been made any more difficult? Kind of give us an idea of that.
Yeah, so for the most part, they haven't changed much. On first-time borrowers, they are scrutinizing a little bit more, but the general overall is not that much different. Now, that comes with a little bit of a caveat because there are certain markets that have been hit harder than others, through COVID. So, for example, New York, New Jersey, where I am, we've been hit pretty darn hard through COVID. So, that's, and it shows up, in the collection numbers where we've had to stay in our house now, for 2+ months. So, that's definitely hurt. People have lost their jobs all over the place, and it showed up in terms of people paying their mortgages, and therefore, obviously, in terms of how lenders are going to look at new deals moving forward. So, New York, New Jersey definitely been hit hard. There are a couple other markets that Freddie Mac and Fannie Mae are scrutinizing a little bit more. And this is, within the last couple of weeks. So, New Orleans, Houston, Orlando, Nevada, Oklahoma, those are a few of the markets that, they're going to be shrinking their loan to values by 5%, and they're going to be upping their debt service coverage ratios by 0.5. So if, for example, if it was previously an 80% market with a 120 debt service coverage ratio, now it would be a 75% market with a 125 debt service coverage ratio. So, it is a little bit market specific, but again, as a whole, they want to put money out there, and, again, they only make money by putting out money. So there's definitely a hunger out there to make new loans. When it comes to balance sheet lenders, the banks, we've seen most of them are going to be at a 6-month debt service reserve. Also, again, very strong rates. A lot of these, larger balance sheet lenders, 30-year amortization, non-recourse loans. But they're gonna go through your collections very seriously, and they're gonna look at and see what's going on in your property, how it's performing over the last couple of months. Now, having said that, and this might lead into the next part of the conversation, as I look at it optimistically, and the way I see it, I just read something from the NMHC, which is the National Multifamily Housing Council Association, which is one of the main places that you go for information, where collections as a whole in the U.S. In the month of May was only down about 2% from where it was 2019 May. So that I think is a very, very, very good sign. Just spoke to a client the other day in Tucson, and he told me he got over 100% collections last month. So all in all, I think there's some very, very positive things in the market, and that's the way I choose to look at it. You could be a Debbie Downer and just look at New York and say the sky is falling, but when I look at it as a big picture, there's still a lot of money to be made out there. And the lenders they're looking at these, most of these markets fairly aggressively.
No, for sure. Those are great points. But just like you said, I think that the demographics of the tenants, the occupation demographics are very important. So hard-hit areas like West Texas, where it's very oil dependent, natural resources dependent, and areas where it's, certain places in Arizona and Florida, where it's tourism dependent. Those areas obviously have been hit hard. But as far as the overall rent roll, I've kept my team's kind of vision was to be able to get into the market now at to get a great deal for our investors. But it's we were hoping to see really low rent rolls, and with all the deals we're looking at, their rent rolls are still pretty high. So that's shocking to us. But that's because the Fed stepped in, the federal government stepped in, and also a lot of sponsors and a lot of the property owners, the systems were in place that actually helped the tenants to apply for certain grants from the government, certain payments from the government to pay their rent. So that system was in place. So when you say that, hey, they actually got a higher rent roll than they did last year, is because they didn't have to pay for those rents. But moving forward, again, there are just so many unknowns involved with the COVID situation, because it's a global financial situation. It's not only regional, and just like Keaton and Monica and yourself kind of you guys mentioned about it, that there are unknowns. So people might be able to pay their rents today, but we're not sure what's going to happen. So it's important to keep our kind of focus to the next few months here, especially when we come into fall, and with the possibility of the second wave of COVID coming, and we'll see what happens with that. But it's been much better than expected, anticipated. So no, I really appreciate that. Also, so kind of give us an idea about the forecast. Kind of, this is totally your personal opinion. It's not give us a short term. I think you talked about the short term, but give us a long term, especially when it comes to multifamily. It's one of the best performing assets is this rental multifamily apartment community kind of style assets. So give us an idea of long term how you feel about the market moving forward.
Yeah, so just one more point before I go there. Just when we're talking about the bridge lenders that we started off, talking about those different types of lenders, we've seen in the bridge lending community, initially they completely fell off a cliff and just stopped doing business for about 6 weeks or so. In the last few weeks, they've come back to the market, but they've come back to the market slower and more conservatively. So this kind of ties into the next, portion of moving forward, where they've been reluctant to go over the 70% loan to cost, where in past, they've gone to 80% of your purchase price plus 100% of your, capital improvements that you would put in. So they brought that way down to where they're capping out at about 70% of loan to cost. They've upped their coupons to about 5 to 6%, where previously it's been about 1% lower. So, and their thought process for that is, as one of them explained it to me, was, typically when you take out a bridge loan, you're doing it for a turnaround property where you're trying to get in, redo a bunch of the units and raise the rents. So their thought process is, hey, I don't really know where the rent bumps are going moving forward. They told me that they're looking at one of my deals right now, and they said we're not underwriting to any rent bumps over the next 24 months. So that's something obviously to keep in mind moving forward. Having said that, again, I'm an optimist by nature, and people are always going to need a place to live. That's definitely, always there. And, on the optimistic end for people like you and everybody else listening, this might be a little bit of the correction that people have been predicting for a long while over here. And, we haven't seen it so much yet, but cap rates might start going up just a little bit, to make these prices a little bit more affordable. And I had somebody right when COVID hit, he told me, he said, Morty, I want to take out as much cash out as possible because, when things start coming down and when prices start moving, I want to be the first one in to get in, and cash is king, as we all know. So, again, moving forward, I do think there's a lot of opportunity in this market. And, we want to be along on the front lines along with all of you. And, we're optimistic, that's for sure.
Great. No, I appreciate that. Thank you so much. And Morty, I'll definitely have you back on. I keep calling you a show, but I'll have you back on one of my future webinars after you help us with one of our future.
And just one more thing, just to put a bow on that. Just the other day, I just remember this as we were speaking, we had a Zoom call where we had our Florida office, our Ohio office, and our New Jersey office on the line. And we saw throughout that call about 8 to 10 new post-COVID deals that were put into contract. So again, just to keep along those, that same thought process, maybe prices have moved just a little bit, but not enough for everybody. So, but again, the positivity is there. And, like you said, moving forward, I think we're all in a good spot over here.
No, for sure. And our partner, Dan Hanford, closed on a $50 million deal not too long ago. So now smack in the middle of the COVID situation. They had a great discount from the seller, but that was a big project to close. So you know what, Monica and Keaton, if you'd like to comment, kind of make any comments or any kind of closing comments, please go ahead. Sometimes as other guests are speaking, items come to your mind. So if there's something you'd like to add, please go ahead. Yeah. Is there something? Everything good? You guys are good? Perfect.
I'll let Monica go first if she has anything to say.
Thanks for having us. It was great. And I love what everyone had to say. I think it was really real advice. We are operating in these, times of uncertainty. And like Morty and Keaton said, and yourself, none of us have this crystal ball. So I think everyone really needs to kind of give yourself a real self-assessment right now in regards to your wealth. If you do not have a job right now, or it's on hold, that's very scary. That we all really need to have these residual streams of income coming in. Your true indication of wealth is how much income do you bring in when you do stop working. And we've had a large percentage of our population stop working. So you mentioned earlier, your house is not your investment. Too many people are dependent on their jobs, dependent on their house. And if the property drops in value, your house is a liability because it does not bring in income every month. So you really do need to have some hard real estate in your portfolio, but you also need to really assess what is a liability versus what is an asset. If you have negative cash flowing properties, now's an excellent time to offload them because the market still is hot now and we are in need of inventory. So you need to set yourself up financially first, make sure that you're not going to be a victim. It might mean selling some of your assets now because we don't know what's happening. So if you are tight on cash flow, it's something they should do. But definitely or like Morty was saying, a lot of people are refinancing a lot of their things and ready to buy. So give yourself a self-assessment now, see how well you're going to do. Don't ever be scared to buy as long as you do it right. And I think everyone had great advice on that this evening. And if you have all the answers, there's no need to operate in fear whatsoever. And with a supportive team like you're putting together, August, people can really move forward in regards to whatever situation, because we have no idea what the situation is.
Fantastic points. Fantastic points. Keaton, if you have some words to finish everything up, I'll bring you back in here quickly.
Yeah, I'll keep everything short and sweet. If you're a real estate investor and you want to connect, I'll post my cell number. I'm happy to help plan out portfolios. And if you're a realtor or someone in the industry, my partner and I operate very, very differently to try to provide a competitive edge for you working with your clients. So hopefully we can connect, and that's about it.
Awesome. Great.
Likewise.
Yeah. All right, Morty. All right, Monica, Keaton, thanks guys for coming. Thanks everyone for watching. And, I'll keep on bringing, great speakers like we had tonight, lots of educational content and informative information. And hope everybody enjoyed it, and have a wonderful night, everyone. All right.
Thank you.
Cheers.
Guys.
Bye.